then we know at some point over the next probably 2 years, the Bank of Canada is going to cut by 250 basis points. I think they'll do 100 basis points in 2024 and then get to probably 3% by the end of 2025.
Welcome to the Tom Storey Show with Steve Karrasch and Tom Storey, where we discuss everything real estate or whatever else is on our minds.
Welcome back, everybody, to another episode of the Tom Storey Show. I appreciate you being here. This episode is sponsored by Realty Ninja, and you will learn more about them later in the episode. If you're watching us on YouTube, you can tell I've finally given in. I've shaved my mustache. We are now well into December, and I didn't want to creep people out anymore. But Steve, you kept it, and you've got a black eye. What's going on? Are you getting in fights in the street?
Market's tough these days.
The market's
Steve
really...
Steve looks punk as hell right now, and I'm for it.
I don't know. It was a tough negotiation last night. You should see the other guy.
He was huge.
It's starting to look cool though now. Like that last night, it wasn't a big deal, and now the color's coming in. So I think this is the first black eye I've had since I was 12, and I'm loving every second of it.
You got it stage diving in a hardcore show?
No, I got smashed by a 6'2", 220-pound man in jiu-jitsu last night. So,
well,
yeah,
it looks pretty cool. I think it looks good.
It's actually
a
cool story.
Yeah, it's totally cool, right? Yeah, except for the fact that I was the one getting smashed. But.
Well, hey, if you like Steve's look today, give us a like on YouTube if you're watching us on YouTube. If you haven't already joined the show, our next goal is to hit 4,000 subscribers on YouTube. So if you're showing up every single week and you're enjoying it, all we ask is you hit that subscribe button and like this video. If you're listening on the audio platforms, I hope you're having a wonderful day. We've got a repeat guest this week. Brendon Ogmundson has joined the show. He's the chief economist of the BCREA. He is a wealth of knowledge. The last time he was on our show, we were much smaller. He agreed to come on, and the show has doubled or tripled since then. And that's what we anticipate will happen after round 2 on the show. So welcome back.
Easily. Great to be here. When does Steve get his name on the show? Has this been like an uncomfortable discussion? Like, part of the show, and yet don't see your name anywhere?
You know what?
What happens is if you're friends with Tom Storey, he tells you, listen, you are my friend, okay? Yeah. This is the deal. You get to come along with me, but my name's on everything. So I said, okay, let's do it. I like you, Tom.
All right. There.
That is absolutely not the truth of how it happened. We actually did talk about that the other week. I was like, why don't we just rename the show to like the Tom and Steve show, the Steve and Tom show? But it would kind of, it's been building now, so I don't know if that would kind of take us off track, but just so the listeners know and everybody knows, just so everyone knows, it truly is a 50-50 operation here, and Steve is a huge part of this show. Brendon, okay.
Yep. All right.
You're an economist. It's probably been a pretty dull year for you, right? Not much going on. You've been taking a lot of vacations, not many things to do, not many people to speak to. Does that sound about right?
It's been a pretty boring decade for economics, really. Since the start of my career, which coincided with a global financial crisis, it's just been very, very dull. Yeah, no, it's I always say I hope for at least 1 year they'll be really, really boring, where we just have like flat sales, flat prices, and no one wants to talk to me. I think that'll be the best year possible.
And do we feel like, we'll cover a ton of topics on today's episode, but I want to start here. So, we're ending off 2023 very, very soon. We're moving into a period of time where at this time last year, everybody thought that 2023 was not going to start very strong. And then it kind of surprised everybody. I'm sure maybe including you. Maybe you saw it coming more than we did.
Oh,
no. Okay. So I feel a little bit better about my predictions for this year. Now, at this moment of time, 5-year fixed rates are sneaking at 4.99 again at the banks. Inventory has come down for a few months in a row. Bank of Canada held in early December. Is this the new bottom moving into next year, or am I just making things up?
I think that 4.99 is like a special offer rate from like one particular bank, because the average 5-year fixed rate is still, it's come down, but still 5.99.
Gotcha. Okay.
So there are some offers out there that are better, but the average rate and the deep discounted rate is around 5.5. 5-year bond yields have dropped almost 100 basis points though. So 5-year fixed rate should come down a lot. I think we're expecting them to come down close to 5%, too close to 5% by the end of 2024 and maybe faster. I think in terms of sales, we're probably in the last couple of months in BC, but as low as we're going to get. It was a really weird year. We started extremely low. So BC, an average year is about 85,000 sales. In Vancouver, it's about 32,000 sales. We started the year in BC on like a 62,000 sale pace and carried that for a while. When the Bank of Canada went on a conditional pause, though, we did see sales come back to what felt like a surge in sales, but it's really from a super slow pace to normal, like long-term average on the dot. But it felt like sales were really picking up because they'd been so low. And then as soon as the Bank of Canada raised rates again in June and July, sales are now back off like 20 to 25%. That rate hike in June and July really changed expectations in markets about how long the Bank of Canada was going to be at sort of these levels, and also how high they were going to get in terms of their overnight rates. So that caused a huge surge in bond yields. We hit almost 4.5%, which is like almost a 20-year high in October. That caused 5-year fixed rates to go over 6% for the first time since like 2007. That meant a qualifying rate of over 8%, which 8% hasn't been a relevant mortgage rate in Canada since like the middle of the year 2000. So kind of unprecedented, like not unprecedented history, but unprecedented for all of the clients that you guys have, and that probably most of the realtors listening to this podcast have never dealt with rates that looked anything like this. So fortunately, it does seem like fixed rates are coming down. They might come down 50 to 100 basis points for the next year, but they're still going to be a lot higher than anyone has kind of grown accustomed to. But we should see a rebound. I think sales will start to pick up second half of 2024. I think we're in for a bit of weakness still because it's still tough to qualify. And the rates have come down a little bit. It's still going to be tough to qualify, in the high sevens for most borrowers. And prices haven't come down much. So affordability is still pretty tough. I think that's going to keep sales a bit sidelined.
I saw someone comment on one of our recent videos, and they said, everyone's talking about this housing correction, right? And this was like a consumer. I don't know who this person is. They're like, I see a sales correction. I haven't quite yet seen it in prices like I thought. And I thought that was kind of interesting. Like, of course, we're down from the peak. That makes sense for all markets. But are you a little bit surprised that like the actual average price of properties hasn't dropped more by now?
I think our forecast for this year for BC's average price was about $925, and we're going to average $970 this year. So I was pretty surprised. The average so I'm on this Economic Forecast Council where we get together and provide the Minister of Finance in BC with the forecast for the next year or two and what we think of the housing market. The average forecast for last year for the average price was $917. And, again, we're going to hit about $970. So everyone was wrong about how resilient prices have been. It's really still a supply story. Inventory, even though it's up, it's still super, super low. In BC, we're trending around 30,000 active listings. We need to be like at 45,000 active listings for it to be in like long run balance. So if sales are just normal, average kind of sales, like 70,000 a month, we need 45,000 listings. We're at 30. So listings have to grow 50% to get to healthy long run levels. And we haven't been there since like 2012.
And if listings aren't, sorry. Yeah. And if listings didn't even get there through the last 12 to 18 months, is there any possibility we get to those numbers that would put us in that like healthy market inventory?
It's really hard. It's one of the reasons why, like when sales were just normal in the spring, that prices were kind of surging. Like prices in Vancouver were pretty close to their all-time peak at one point in 2023, because the inventory is so structurally low that it doesn't take much of an increase in sales to get markets really, really tight. And then prices start to accelerate. So There's risks. So we'd have to see, like, this is with like inventories accumulated, but from such an incredibly low level. Like during the pandemic, we had 15,000 total active listings in BC, which would be like an okay number for Vancouver alone. But for BC, it's obviously pretty low. So we're digging out of a really big hole in terms of total inventory. To get from 30,000 now to like 45,000, we'd have to continue the very slow pace of sales we have now. And we'd have to see a very large increase in new listings. And that's possible if we have, there's still risks to the economy in 2024. Again, just got back from the most recent Economic Forecast Council meeting. There's still some economists that are forecasting a recession. Most of the sort of consensus is like just really slow growth in 2024, but there's still a risk. The impact of mortgage renewals, especially in more like 2025, is real. People are going to be reset at 30-40% higher mortgage payments, even if rates come down. So there's a risk that if the economy deteriorates and people are being reset on their mortgages at much higher payments, that we could see new listings really pick up. I thought that was sort of the worst case scenario for 2023, and we're kind of bumping that in 2024 since it didn't. Listings were super low to start the year. This year, they're about 30% below normal. They've sort of gotten back to normal in recent months, but so that's sort of the scenario. It can happen. In the financial crisis, we went from 30,000 to like 55, 60,000 in like a couple months, but that's a special case. I certainly don't think that's going to happen. But so, yeah, we would have to have an absolute surge in new listings and like real sort of desperation type selling. And when you look at household sort of financial vulnerability, it's really hard to see that scenario playing out. Like mortgage arrears are still 0.12% of outstanding mortgages in BC. Consumer bankruptcies are at a record low. Savings rates are still really high. So households seem to be in good shape. One of the stats I've been quoting a lot in presentations is 54% of BC owner households have been in their homes for 10 years or more, which means over 50% of owner households have accumulated a massive amount of equity from price appreciation. Prices doubled in the last 10 years. So if you've been in your house for 10 years or more, you've experienced a massive accumulation of equity in your home. That makes you somewhat less vulnerable to interest rate shocks and everything else. Also, 45% of BC owner households don't have a mortgage. It's like 50% in Vancouver.
Is it that high? It's almost half of households no mortgage.
Yep.
And it's mostly owned by boomers that have just owned it for 30 years, basically.
It's always popular to blame baby boomers. So yes, with all those baby boomers,
they have all the money. They have all the money.
Yeah. I'm sure there's some early Gen Xers that have paid off their mortgages too, but yeah.
Now, here's not just the $1 million question, but the $1 billion question. Is the Bank of Canada done?
Yeah, I think so. If you look at, and obviously the economy contracted in the third quarter. We thought that it had contracted in the second quarter too, but that got actually revised up to about a 1% growth. But core inflation, what I've watched the closest, because it's what the Bank of Canada watches the closest, is the trend in core inflation measured as CPI trim and CPI median. Those are just ways of throwing out the most volatile prices. And we've had real meaningful progress in those measures after like none for months. So I was worried after the September CPI showed a bit of an uptick in core inflation that we'd get a rate hike in October. That didn't happen. You can thank me for doing a reverse Jakes on that one.
Thank you.
But I think now that we've had like 2 months of a downtrend and some other, it seems like food costs are coming down. It seems like obviously energy prices are down a lot. That doesn't really get factored into core, but it'll make a big difference in the headline. Shelter costs are tricky, but I think the Bank of Canada might look through that. Obviously, rents are still rising at a really fast rate. It's really hard to bring rents down because there's tons of pressure on the rental market from both immigration and just demographics and affordability. And it's really hard to increase supply of rental units. We'll get like mortgage interest rate costs, which are a big chunk of the CPI. That will start to fade, kind of the year-over-year impact, because mortgage interest rate costs aren't going to be 30% higher, a year from now, like they are today.
Because that's a big chunk of it, right? Like that's what gets it over 3%.
Shelter costs are 30% of CPI, so they're the biggest weight by far, and about 2/3 of that is ownership housing. And in that ownership housing is both prices, sort of, and some like maintenance costs and mortgage costs. So it's a big part. I think mortgage interest costs are, I don't know, 5 or 6% of CPI.
Okay, so you talked about rentals there.
So I think unless we see like a meaningful increase in that like if core inflation starts going the other way, or we get some much stronger economic data, I think candidates most likely done, and probably I think all of the conversation is going to shift in the next year or two. When is the Bank of Canada going to cut, and by how much?
And we're going to get there, but I'm going to make the listeners and viewers wait till we get there. So the case is closed. The Bank of Canada is done. Okay. Now, on the rental side, Steve, I want you to take over here because you're more of an expert on the BC side of things than I am, obviously, here in Toronto. Ravi, friend of the show, Ravi, who's been a guest, has really put a lot of things in place to find more housing solutions. Steve, take over and ask Brendon what we need to know.
It's crazy. So I'm assuming that you're trying to stay up to date on all of this, Brendon, but the NDP's brought in sweeping changes, like massive sweeping changes. So my question for you on that with this fourplex zoning stuff that they're doing, with all of these changes that they've made, has the BCREA yet factored in that, or are you trying to factor that into your future projections? Because is this something where you're going to take a single family lot and have it double in value? Is this actually going to restore any sort of affordability, or is this only going to make it worse?
This episode of the Tom Storey Show is brought to you by Realty Ninja. Hey, real estate agents, I bet you didn't get into the real estate industry to try to become a web developer. Realty Ninja will help you build a beautiful website for your business without becoming all techie, because me and Steve are certainly not techie. They'll set up your entire site for you, they'll migrate the content from your current site, and they'll take care of all the back end, switching the domains, all the things that you don't want to do, they'll take care of for you. Their team of in-house designers will make your new site match your current brand and help you stand out from your competitors. Best of all, Realty Ninja offers a free unlimited trial that lets you build out your website, and they do not charge you until you're ready to launch. That's right, they're so confident in their product and that you're gonna love the website that you build with them. They will not charge you until it's ready to launch. They don't even take your credit card details. Listeners of the Tom Storey Show will not only get an unlimited trial before you launch, but if you go to realtyninja.com/Tom, you will get 20% off your first year after you launch. A beautiful, functional, and professional website is absolutely a must in today's real estate landscape, and Realty Ninja delivers. So go to realtyninja.com/Tom for 20% off your first year. That's realtyninja.com/Tom. And now back to the podcast.
So we wrote a whole report on simulating the potential impacts of the Homes for People plan, and basically modeling it after the results that were achieved in Auckland, New Zealand, who also did a massive upzoning. So we did all this modeling work. What really matters at the end of the day is there's a lot of noise. The signal you want to look for is completions. So are we bringing more new units to the market? Until we have a ramp up at completions, it's all just conjecture. So these are good policies. I'm certainly in favor of all of these policies. There are ways to get more supply. I think it can be done better, like some of the cases where you can have 4 units on a lot or 6 units on a lot, but you can't change the FSR, so you're not really building the way you might want to. You can't use the whole lot. Like in a lot of those cases, you can't just put like a 4-story walk up with 4 units, right? You have to, it's like a carriage house or whatever, a basement suite or something. It's not the best way to use the lot in all those cases. The transit stuff is great. 20 stories around transit makes tons of sense. What you're suggesting, like our price is going to rise because now like the land lift, all that density. The theory is if you do this kind of upzoning in a widespread way, then there's less competition for just, this one lot is being upzoned, so everyone's going to bid on it. If everything gets upzoned, you get less competition for those lots because you can have density everywhere. And that should mean that the overall, the price of that land doesn't skyrocket like it would otherwise. It's going to go up for sure, but then on a per unit basis, we should get more affordability. That doesn't mean that like if you build a triplex, they're all going to be $400,000 all of a sudden. They're still going to be over $1 million, but that's better than one house that's $3 million.
What happened in New Zealand? What was the end result? Because I keep hearing that they're modeling this after some places in New Zealand, some places in California, in Oregon. California and Oregon probably not the best models right now, specifically California, because their house prices are just as crazy, if not crazier than here. So what made this thing in Auckland or wherever it came from so successful that everybody's modeling after it?
So they did an upzoning similar to what we're proposing in BC. They got a huge amount of what they call consents, what we would call permits. So a lot of new construction activity. Most of that activity was in the type of missing middle type housing we need here. So they got, fewer single family permits, but lots and lots of apartments and townhouses. And over sort of the 5 years from like 2015 to 2020, rents in New Zealand, in Auckland, were essentially flat, whereas they rose in Wellington, New Zealand. So if you kind of do this kind of natural experiment, Wellington didn't have an upzoning, Auckland did. In Wellington, rents went up 25%, and they were essentially flat in Auckland. The same thing happened in the Midwest of the United States. I think it was Minneapolis had a big increase in construction activity and approvals. Their rents actually fell like 20%. And then in like Indianapolis, didn't do nearly as much. Their rents were up like 20%. So you have these like cases where you can compare like cities. One instituted a policy, the other didn't. And in every case we've seen, the ones that did had much better affordability metrics. And it's all of these rents because of the exact thing you bring up. If you look at prices go up when you do this kind of rezoning.
That's what I was going to ask. Is this mostly rental? It's mostly helping on the rental side, not the average sale price side?
Yeah. In these cases, they all use rents as their price metric because the land prices go up. We'll see what happens here in our modeling. What's really important is to lower the long run rate of price growth. So right now in BC, or not right now, but over history in BC with tons of volatility, average prices have risen at like a 6.5% annual rate, which means that prices double every decade. They doubled over the past decade. They'll double over the next decade if you get slow price growth. It's really hard to slow down price growth if you don't have sort of abundant supply. So if we could increase housing starts by 50%, which is no small task, and get, that equates to about a 40-something% increase in completions over a pretty high baseline, we could slow price growth to like 3% in BC and start to bend the affordability curve. So what's really important is that we slow price growth, let income start to catch up, rates come down, the overall affordability equation, starts to bend. It takes a very long time. So if we could start really ramping up construction right now, we would start to see a flattening of affordability in 2028 in our modeling and a bending of that curve in the mid 2030s. Because it takes a while it takes years to complete, to get, to build an apartment building right now. The permitting process takes a very long time. Completion times are like 2 to 3 years for larger condos, especially. And then the effect of how like new housing filters through the rest of the market. So lots of studies show this as well. If you build a lot of new housing, no matter what type of housing it is, I know people always say, we only build housing for investors and rich people, but no matter what type of new housing we're building, what tends to happen is that it frees up the resale stock. So higher income households move into new housing, frees up the resale stock for moderate and lower income households. That's who tends to fill in on the resale side. So you have this filtering effect, listings rise, price growth slows, affordability improves. That's the way it's supposed to work. We'll see. Again, lots of noise. The signal over the next few years is watching completions. Are we actually completing units at a much faster pace? Because if we're not, then nothing's working.
I think there's a very good chance that the latest announcement, and this is just an announcement like, hey, we're looking into this. It's not like one of the guaranteed things yet, but the latest announcement that could make the biggest change in how we perceive a home in the lower mainland of BC is they're now looking at single egress staircases as being implemented into the zoning plans, I guess, for this new fourplex. So in English, if I understand what the heck that means, because I had to look it up, it means you can now build effectively let's call it a 4-unit apartment building, because you can have a common staircase for all of the units. And that would be a massive change.
It's those little details that matter a lot, because if you can't have a single staircase, then it gets very expensive to build and you can't have as many units, because I guess the way the staircases have to work. Parking's the other big one that always throws a monkey wrench. Like, you can't, if you have 4 units, you also have to have all these parking spots, or if you have, a certain amount, which means building a parking garage, like digging under or whatever, and everything gets more expensive. If you can just build single staircase with no parking, apparently it's gets much more economical.
So this is all good. We're happy with all these changes, but best case, if the starts happen, okay, because again, the models are always right. We haven't talked about that yet. Okay. Always. So if the models are always right, then by 2028, we're going to feel it a little bit. And by into the 30s, we'll actually see it, which will get us to 3% growth per year instead of 6 over the decade after that, I guess.
Yeah. And this is always compared to a baseline. So our baseline is things get worse because prices just keep growing, even not at an accelerated rate. It doesn't take much at $1 million average price, compounding at 5%. Things get out of hand pretty quickly.
Yeah.
So, and that's not even that high of a price growth. So the baseline things get worse, right? Because price growth outpaces income growth and rates. In our models, our long-term 5-year fixed rate is about 4.5%. So that's about 150 basis points higher than it's been over the past decade. So we're not getting a lot of help on mortgage rates in terms of affordability. Prices keep growing. It's kind of hard to see affordability improving unless we can really slow down price growth. The only way to do that is to increase long-term, is to increase supply or have some, especially given our demographics, there's going to be lots and lots of demand over the next 10 years. We have more people in that 25 to 40-year-old age group that tend to buy homes or form households. We're going to have more people in that age cohort than at any time since the 1970s. So demand's there. We need to be able to put those people somewhere.
I have a very specific question. I'm going to hold you to it, and we're going to come back to this next year when we have you back on. Okay. If I'm betting right now, or at least the modeling, let's call it the modeling, 12 months from now, where are we expecting prices to be? You said that you have that figure of 975 or whatever that was way off. We weren't expecting an uptrend this year, or I wasn't anyway. I was expecting a slow, steady downturn all year long. And then we saw a spike and an up and a down. So 12 months from now, what's the projection?
Is this December over December or an annual price?
Let's do December over December if we can.
It's tricky because even December over December this year, we're going to be up because last December was really low on the average price.
Yeah.
I started the year below 900,000. It's the January was 867 or something. And I can't remember what December was, but it was really low. This December, we're at 965 in November. Let's just say we're at 960 in December. Our forecast for next year is an average price of 995 or something. So up. Let's say we're going to be around there in December.
Crazy, because here I just did the numbers. I looked at the one I report on my channel is the Surrey combined numbers, and so Surrey combined condos were 4.5% up which I thought we were going to see that in the other direction. So 10% difference, basically, let's call it. And then townhomes were 5.9 and detached were 6%. Because if you would have told me in our last conversation, and I actually re-listened to our last conversation to prepare for this, and everything was doom and gloom and craziness. And it's funny to hear how far we've come since we met you a year ago, and then how much we're talking about the exact same talking points.
Yeah,
because a lot of it is identical to try and live with inflation and all those different things.
A lot like 2023. Yeah, and that was probably before. I mean, if you told me at the start of the year that we have an 8% stress test rate, I would have thought we'd have a much, much worse housing market. And like sales are bad, especially the last few months. We're going to finish the year in BC at like, I don't know, 74,000 sales total, which is a really, really low number. Vancouver's going to be like 26. Fraser Valley is going to be, I think, like 13 or something. It's very, very low anyway. So really low sales, but really firm pricing. And again, it just goes back to the listing side. If we just don't have the listings, it's really, really difficult to get, prices down if we don't have an oversupply. So
do you think that sales volume in 2024 will be better than 2023, number of transactions taking place?
Yeah, so our forecast kind of has a dip and then almost a U-shaped recovery. I think once it's clear the Bank of Canada is cutting rates, I think that's going to just spur a lot of pent-up demand, especially if 5-year fixed rates are down. I think we'll have a similar situation to what we saw in May and June. Like, I don't think we're going to get that right away because the qualifying rate is so high. But if we have 5-year rates come down to, say, even 5.25%, so that the qualifying rate's lower, plus you've got certainty from the Bank of Canada or expectations the Bank of Canada's cutting, I think that's going to push a lot of demand that's on the sidelines now back into the market, and we'll get sales picking up. How did that happen in the second half of 2024? Whenever the bank, it's really kind of clear the Bank of Canada is going to be cutting. I think that's the most likely scenario. That doesn't mean never play out the way you think they're going to. But I think that's sort of likely. And if that happens, we'll have sales that are slightly higher than this year. I can't remember where our forecast is. I think it's around 80,000 sales in BC. So still below average, but on an upswing heading into 2025.
When you look at the prices that have, I think for all three of us, kind of surprisingly in all of our markets, held up stronger than we anticipated, although the sales volume is very low. And then you try to figure out, like, okay, why did that happen? And you could talk about the extension of the amortization on the variable rates, but now even the people that are renewing on the fixed rates, the banks are saying to them, hey, Brendon, you want to put it back to 25 years? You're at 15. Now, I don't think for you as a homeowner, it's necessarily a great thing because you're paying more interest over a period of time. But like, there's all this talk about what is propping up the market. And we haven't even talked about this mortgage charter, which probably isn't going to actually do anything. But why have prices not fallen? Like, what? I know inventory, but we still have had enough inventory that we should have seen enough maybe not in BC, but like, it seems odd that prices are holding like this.
So in the first part of this year, new listings were 30% below normal. I think for one of the reasons why, I mean, we did a bunch of modeling on this too and wrote up a little piece about it, but the sort of factors that drive new listings are the labor market. So if you've got still strong employment growth, people aren't going to be desperate to sell their home. So there just seems to be there's a really strong correlation between listings and the unemployment rate. If you get a spike in unemployment, you get a lot more listings on the market. Unemployment rate in BC has been very low all year. The other one that made a big difference that hasn't mattered in a while is interest rate differentials. So if you got a mortgage in, say 2021 at 2%, whatever low number you want to pick, and you're looking at maybe selling now, you're going to be getting a new house at 6%. So that lock-in effect tends to keep a lot of sellers from not selling that would otherwise. I know sometimes you can port your mortgage or whatever, but I think it's kind of difficult in practice. So that interest differential has made a big difference. If you're going to get all of a sudden have a much, much higher payment on a new home that you're moving into, that might keep people from selling. So that's been a big part. That'll fade over time as rates kind of over like a 5-year period to kind of normalize. I don't remember. Well, prices. So it's like
just the price. Like, how are they holding like they are? It just like it's kind of surprising.
We did get an increase we had very low levels of inventory, and the almost sort of iron law in housing is really like there's a very strong correlation between how tight markets are and price growth. So you get changes when things change really, really fast, and then you can have what looks like a balanced market and prices falling. But generally, like if we have a sales to active listings ratio where you can flip it to months of inventory, if that's around like, about 20%, prices are going to be growing. And if we have a really low inventory, that means we can get to that level with not a whole lot of sales. And again, you have households that aren't super vulnerable to interest rate shocks, apparently, is what we've learned over the past year. We probably talked about this last time too. Households in Canada during the pandemic saved somewhere between $250 and $350 billion. So they have a massive cushion to absorb a lot of the shocks that we've seen: higher interest costs, higher inflation. And then of course, even though past year real wages have been rising. So you have a household that have a huge accumulation of savings. They're still employed. In many cases, their wages are rising. And then, like I was saying before, they're either don't have a mortgage or sitting on a massive amount of equity. So when rates go up, it seems like all of those things have been an incredible kind of buffer against rising rates. Really hard thing to model because those aren't normal. This is a normal situation, especially coming out of what was a pretty serious recession, or at least a deep recession from the pandemic. So it's a really abnormal situation we're in, and everything still kind of traces back to the pandemic and how unusual it was.
And I guess, it's a really good point, because even though it feels like, for me as an active real estate agent and for people looking at houses, that there's definitely more homes for sale than there used to be. The used to be was such a low point that we've gone from an extreme seller's market to a balanced out market. But in a buyer's market in some segments of the market, but not across all the way for like a 6-month period, right? It's like those have kind of bumped up. And Steve, have you still seen inventory slowly knocking off every month? Like you're going to end the year. I mean, it's December, so it makes sense. But we got to a pretty good chunk of inventory in Toronto, and then it right away dropped off.
In the Fraser Valley, it went up really quickly between that 5,000 and 6,000 listings. And then as soon as it hit 6,000, it seemed to be there for like a day and a half, and then it started falling off again really quickly. What we're noticing, though, is our detached market specifically seems to be the one that's in buyer market territory, with like 9 months of supply across almost the entire Fraser Valley. And it's strange because those prices, as we mentioned here, are pretty much not moving, even though we're firmly in a buyer's market territory.
Yeah, Fraser Valley is interesting because their inventory is actually one of the only markets that's like fairly close to what we would consider like long run balance. I can't remember what the number is. It's like between 6,000 and 7,000, I think, for Fraser Valley. And we're getting close. It's one of the closer ones. But yeah, not a whole lot of impact on prices. People just don't need to sell. So if you're not like, if you haven't lost your job, if you can still afford your house, or even in a lot of cases an investment property, then they just don't. So they're happy just to hang on to it.
How do we adjust for that with population growth?
Adjust for what?
Just the when you're looking at the amount of, say, active listings or number of sales, like the population is exploding. So is it not that if we got to 6,000 active listings now, and that was regular for the Fraser Valley, where I feel like it is, isn't that now actually low?
Yeah, it kind of depends on how much the population is buying, because it's always, the metric we always use is sales to active listings ratio. So it's always somewhat normalizes for that. If you get there, I guess now at lower level of sales means, I guess you have to have much more listings. You have higher sales. It's still like, if we're kind of in that 20% plus, we're going to be in a sellers no matter what the kind of unit amounts are, right? So it may be if and it's actually kind of true, like the Fraser Valley especially has changed so much that like what used to be normal level of sales, say like 15,000 sales, is now like 18,000 sales. Is like what should be a normal level of sales for Fraser Valley. I think we actually got to like 24,000 or something in 2021, which would be like a bad number for Vancouver, but an extraordinary number for Fraser Valley. So it's true, like sales will grow. And I think our number of active listings is more based on like the past 5 years than, like a really long-term average. So we always kind of adjust it that way.
We had, we're going to end this year for the Toronto Real Estate Board, which has over 70,000 licensed real estate. I'm sure you've heard, right? Kind of crazy here. We're going to end this year probably about 65,000 transactions. Now, again, that doesn't include pre-construction or off-market luxury stuff, but still, it's a good metric. Last year, we ended at 75,000. The year before was 121,000. The last time we were near 65,000 was 2001.
Yeah. And you would expect numbers like that prices would take a bit of a hit.
That's what I can't figure out.
It's funny, though, because when you look at the metrics, like for BC, so sales this year are really low, and the annual price, if you just add up all of the volume over the course of the year and divide it by the units over the course of the year, we're going to be down at, still think, like 3% or something. The average price last year was like $990 something in 2022. Average, of course, it started really high and then came down really low, but on average, it was much higher. So it's weird. These price metrics are kind of weird. Like the annual average doesn't always maybe measure what actually happened throughout the year. But it also, like, sometimes the December over December is not really typical either. So it's kind of sometimes tough. But when we look back at history, it's going to show that both sales and prices were down in 2023.
Okay, so there are many people listening to this that have a variable rate, and they've weathered the storm, and they've taken a beating. Their face looks like Steve right now because they keep getting smacked. And it sounds like there's good news in the fact that the Bank of Canada might be done going up. But now the big question is, well, when are they going to start going down? And not just when are they going to start going down, but how far are they going to go over what period of time? So let us know what's going on.
So I think it's helpful to have kind of a benchmark. So where the Bank of Canada wants its overnight rate to be, what they call its neutral rate, they actually have a range for it, is between 2 and 3%. So they think, their models tell them that between 2 and 3%, that's where inflation's back to 2% at its target, and where there's no excess demand or excess supply in the economy. So it's sort of like the Goldilocks sort of rate. So if you think they're going to 2.5%, so just the midpoint, then we know at some point over the next probably 2 years, the Bank of Canada is going to cut by 250 basis points. I think they'll do 100 basis points in 2024, starting in, I would guess, April, and then get to probably 3% by the end of 2025. So I'd say 200 basis points over the next 2 years, maybe more if inflation we get sort of more progress on inflation than is currently expected, or if the economy is a little bit worse. The one sort of risk to the pace is the Fed in the United States is a little bit behind us in terms of their own monetary policy cycle. And you don't want, generally Canada doesn't want to get too far away from the US on interest rates, because you can kind of undo a lot of things you're trying to do. If we're too low, then we're going to, instead of stimulating the economy, we're gonna end up, bring inflation down, because the loonie will decline. We'll get inflation picking back up from both import prices and trade, causing sort of excess growth and reigniting inflation. So you can sort of undo some of the effect on inflation from the difference in exchange rates.
That sounds like something that I didn't think I was going to hear from you, honestly. Do you really think, is that too fast for them to go down?
Did you see when you said that number, how big both of our eyes got when you were like, oh yeah, it's going to come down like 2.5 in the next 2 years. And Tom and I are just...
Yeah. I mean, that's, if over a 2 year period, then we should be able to get back to a 2% inflation target. Right. We're at 3.1 right now, year over year. Energy prices are coming down. All prices are sort of headed in the right direction. There's no reason for the Bank of Canada to be to have their rate at that level if inflation is the sole mandate for the Bank of Canada is to get inflation to 2%. If it's there, there's no reason to be it has set rates so far above neutral. Everything in the models that the Bank of Canada uses, everything in kind of modern macroeconomics, is about sort of gaps. So if the gap between your overnight rate, your policy rate, and your neutral rate is excessively high, it's going to really put the brakes on the economy. And we don't need to do that if inflation's at 2%. So, bring slowly, it's over 2 years, bringing your overnight rate back to 2.5%. Keep in mind, at 2.5%, with given historical mortgage spreads, that implies like a 4.85% 5-year fixed rate. So it's not like mortgage rates are going to be super low.
Right.
That's much, much higher than any buyers have become accustomed to over the past decade. So it seems like a lot lower if you sort of stop banging your head against the wall. So it feels great, right?
I wish I had taken your advice and not listened to Steve in October when I locked in a 3-year fixed over 6% at the 20-year high.
I did not say that.
I'm blaming that on you.
No, Brendon. Okay, you're here. You're going to hear this right after our last call together. I told this guy to take a 5-year at 4.79, and it would have been fantastic. And he did not do that. Do you need insurance? The answer to that question is obviously yes. Of course you do. Whether you are a tenant, landlord, or homeowner, you need to insure your property and belongings. And when I insure my investment property, personally, I choose Square One. Square One is affordable online insurance for everyone. If you apply for your Square One insurance policy using the link in the description of the show notes, listeners of the Tom Storey Show can receive $20 off right now, simply by going to squareone.ca/the Tom Storey Show. Square One is no joke. I personally use Square One for my landlord policy on my investment condo. I picked Square One because they were easier to work with than other insurance companies. And when I had an issue with my previous policy coverage in relation to my Stratas coverage, Square One was the insurance company that came up with a solution for my insurance problem at an affordable rate. Online quotes take less than 5 minutes with Square One. Get your home insurance quote today at squareone.ca/the Tom Storey Show and save $20.
Yep.
Well,
yep.
But okay,
guessing rates, Tom. Guessing rates.
If I'm hearing this right, it's like, okay, you go to where the market was in February 2022. And we've had, has it been 10 interest rate hike? I lost count. I don't know. 10 or 11?
Yeah, basically.
Okay.
75 basis points.
So that got us to a point that from the peak of our market in the GTA, our average sale price is down 16% from that crazy month of February 2022. I'm not sure. Are you guys similar from that peak month maybe?
Yeah, I think we're similar down about, it's like 10% or something.
Yeah.
And some markets are down a lot more. Yeah. Like in the Fraser Valley, prices had gone up like 60%.
Right.
And did back some of it and then got back some of it. So, yeah.
So it's like, okay, that happened, but interest rates significantly up, the fastest in history. Okay, now inflation is coming down. It's working, but housing prices didn't fall as much as maybe people thought that they should have. And now we're going to do 200 basis points cuts in the next 2 years and get back. Again, not to say we're going to 2% fixed rates anymore, but it's going to be in the mid to high 4s. Is the market not just going to take off? If it's still moving like right now, it's slowly moving, but isn't that just going to rocket up again?
I think that's the highest probability, right? If we're going to have much lower rates, we know that the demand is there because of demographics and else. There's tons of housing demand. We still have massive intergenerational wealth transfers, which is really important in big cities. So, the down payments are probably going to be there. Had years to save as well. People have been on the sidelines. There's a lot of pent-up demand. And if we're going to have any meaningful increase in affordability from lower rates, and we're not going to have a large increase in inventory, then it's going to be really hard for markets to absorb all that pent-up demand once it's off the sideline.
Is there any sort of modeling or estimates for when Canadian immigration slows down, or maybe where it gets so unaffordable that people start leaving? Like, is that been factored in at all? Because everybody always says now, well, it's getting so unaffordable that maybe people will just stop coming. I can't see that to be the case with such a small population compared to other countries.
So the targets for permanent residents is 500,000 per year until 2026. That they extended it a year, but they didn't increase it. BC gets 15 to 20% of that target. Ontario gets, I think, 60% or something. It's a very large number. That means a lot of households. So if, say we get 100,000 people per year at BC, most new immigrant households have a household size of like 3 to 3.3 or something. So it's called like 30,000 households. So it's like an extra 30,000 households per year. Some of those households, most people are already here, just waiting for permanent. So when you think about like housing demand, a lot of people were just here waiting for their applications to be processed, but they were already in Canada, so they're already housing demand. So not all of it was new, but the ultimate effect is, at least in BC, tens of thousands of new households being brought in. That's instantaneous demand that, of course, in the supply constrained market is going to push up rents and prices. What the sort of effect that is on, if you're now an immigrant that the country looking to immigrate to Canada, does that dissuade you? Haven't seen it yet. A lot of the numbers you see, like the really big numbers, are the result too of temporary residents, so students and temporary foreign workers. I think that number is really volatile, and it was really high in 2023 because we're kind of making up for the past couple of years. So that will come down. So some of the really big numbers, like I think in some cases the temporary foreign workers and students, not permanent residents, is at least as high as the permanent residents number, if not much higher. So that will slow down, I think, quite a bit, but we'll still have the permanent resident. So we're gonna have really high population growth for several years, and that's immediate housing demand, and that has an immediate effect on prices. So I don't know. I don't see it slowing down a lot, except for on the temporary, on the non-permanent resident side. But maybe.
So
we're having government. We'll have a new government probably in a couple of years.
Yeah.
That with different policies as well. So it's always, you have to account for that.
So if we take the bullet points here and we go, okay, immigration levels remaining relatively high, Bank of Canada going to cut at some point and cut, fairly significantly. The demand that exists in the housing markets in Toronto and Vancouver and the surrounding, really Ontario and BC generally overall. I'm asking you this as a semi-hypothetical question. This is a me scenario. So this is not financial advice to anybody listening, and me and Steve don't have an agency relationship with you, so we're not telling you what to do. I'm asking for me. Like, this is like not that I'm doing either of these things, but okay, if the thought was, all right, I could just pay down significantly a mortgage that I can still afford the payments for, it's not stressing me out, but I could take a chunk of money and pay it down. Or based on everything that I've just learned in the last 45, 50 minutes, I look at just what the numbers are telling me, what the models are potentially looking at, and I go, okay, well, right now prices are low relative to where they were. They're not low, but they're lower than they were. I'm hearing interest rates are going to come down over a period of time. Immigration staying up. Long story short, do I look at December, January, February, March into 2024 and go, I'm going to buy this, I'm going to own it for 10, 20 years and look long-term on real estate, or do I just pay off the asset that I have?
I couldn't remember the first part. What was the asset that you have?
Let's say you got $350,000, $400,000 cash, and you want to invest in something that will break even right away, or you pay off your mortgage.
Well, it's all about differences in rates of return. So if you have a mortgage with a very high rate, higher than you could get on a return, then it's a good idea to pay it off. If you have a very low mortgage rate and you can get a much higher return on that $400,000, maybe not in the housing market, but somewhere, that doesn't really make sense. Like use the leverage, right? Now, could you, on an investment property, get a higher return than if you, like, well, Tom, you said you had a 6% rate right now, 3 years? It's a shame. could you earn 6%? So your cap rate's going to be pretty low. I think you buy, like, rents are really high, but most condo investors, I think, at least in Vancouver, are cash flow negative.
Most, yeah.
And you have very little ability once you set that rent to increase it very much without removing a tenant, which is also very difficult to do in BC. So your return versus being able to get 5% on a GIC currently is probably not great on the rental side, and your capital appreciation is probably, I think risk is the upside on prices, so maybe you could get a decent return. But if we implement the policies that the government wants to implement and they work, then your price appreciation is going to slow as well. So
right,
I don't know. I would probably, if I had a 6% mortgage, I'd probably be paying that down.
Yeah.
But yeah, I think generally, like, returns on real estate, if we can implement the types of supply policies, or if they work, then rent growth is going to slow, price appreciation is going to slow. So you're really betting against basically continued, really bad affordability in BC. And that might be a good bet. It's been a good bet for a long time. But we're at least trying to fix it now. It's a very long-term solution. So maybe over the next 10 years, you can still get decent returns.
And maybe option number 3 is if just throw that money into a GIC now, lock it in at 6%, because if Bank of Canada does come down, the GICs aren't going to be at 6% anymore. Steve, you've got something to chime in?
Can I give you Tom Storey? This is financial advice for you. You've just redone your mortgage. I'm assuming, knowing where I know you have, which institution you're at, you probably got somewhere between a 13 and 20% original borrowing pay down per year. So if I had a
you're good.
lump sum, right, I would take that lump sum per year. I would put down as much as I could, but I would do it again next year in the calendar year, and I would do it again and again. And then on the other side, you're going to now be making these astronomical payments because you can't adjust those. But what you owe on the other side, you're going to be very happy that you paid them down in the future. And knowing your family situation, who knows, you might be ready to move up to the next house, right? So pay down that mortgage.
All right, there you go. You heard it here. That's kind of what I was thinking, is just do the lump sums every year until the 3 years are up, and then hopefully I can get a 4.5% rate then.
But isn't this is the conversation I've been having with a ton of clients right now, because I'm getting those phone calls from people that want to invest right now. And I have spent a ton of time talking people out of investing because, well, it doesn't take a ton of time once I tell them they're going to negative cash flow $700 a month. They usually shut it down pretty quick after that. But there's a big appetite of people that do have the 20% that want to do something with it. And there's 2 situations where I'm telling them to do it. Right now, if you do have that, put it down on your principal residence. Or number 2, if you're already own a principal residence and you're looking to buy that investment condo, right now I'm really encouraging people to upsize their home, because detached has come down so far. And with everybody being super favorable to basement suites right now in our area, put that income in your basement and you're going to do way better off in the long run than taking on another set of property taxes, another strata fee, and all these other expenses. Like when you have that when you have that rent coming into your principal residence, it's all going towards you. You're not doubling up on these other fees.
And there's some incentive programs that they coming out to put in basement suites where they match the dollars in some 1A or something. So yeah.
So I did have that. I had my first client reach out about BC's incentive, and it's like a $40,000 forgivable loan.
Right.
Or no, sorry, not
below market rents or something.
But there's also a household income cap.
Oh, okay, yeah.
Which
there was fine.
Exactly. So nobody's actually going to use it, right?
Policies so that no one will use them.
Totally. Yeah. Let's make this great policy that nobody's ever going to use so we can look like heroes, right?
For like a basement suite where, like, if you're in a house that's large enough to have a basement suite, you probably have a certain income anyway, but then you can't put it in a basement suite. So, I don't know.
So are we looking at all of this as like, this is a bit of a soft landing if they come down as like we think they're going to? Do
that basically never happens. If you look back in the past 100 years, every time inflation is spiked, it's taken a recession to bring it back down.
Are we in a recession?
No.
No.
This year looks it's starting to look more and more probable that we have a soft landing. So if we can get inflation back to 2% without sacrificing much in the way of output and employment, it's kind of a miracle. I mean, we could, like, with the timing of rates, we could time it perfectly. And that almost never happens. So there's certainly a risk that it won't happen this time. We could, we ask, are we in a recession now? Like, I guess we could be, like, if in a technical way, like the third quarter contracted by 1%. We're in the fourth quarter right now.
All right.
It's tracking 0.5 or something. So that could be negative. Hard to call something a recession when we're still creating jobs and unemployment rate's really low and wages are rising. It's really hard to label something like that as a recession. So I would look for, we have declining growth, plus the unemployment rates are really spiking up. We're seeing job losses month after month. That's a recession to most economists. The sort of technical idea of GDP contracted, but maybe it's because, like, inventories were down or some, like, really, really volatile part of GDP in the national accounts. It's kind of hard to label that as a recession.
Now, when you
Tom, sorry, I'm going to break in.
When
we were in a conference last week, Ben Tal was there, did a presentation. He actually says we are in a recession right now. And what he said, the way he broke,
it's a housing recession, which isn't, I don't really know what that
means.
means.
What he said was, when you break it down per capita.
Oh, okay. Yeah. That's never how anyone defines recessions, but yeah, per capita GDP has been falling for a while because we have very high population growth and low economic growth. So obviously, in per capita terms, we have seen declining. That's how we're going to compare international living standards, is by looking at per capita GDP. It's kind of tough though. Like, these are long-term things. If you have a whole bunch of population growth, you're obviously not going to immediately get the gains in productivity that you would need. So when you think about GDP, is two things long-term. So how an economy grows long-term is all about how much is your labor force growing? So how many people do you have making stuff? And then two, how good are they at making that stuff? And we call that productivity. So the sum of, like, productivity and labor force growth is GDP growth. Right now, we have tons of labor force growth largely because of immigration. But if we have a lot of people who are new to the country, they're not going to be immediately awesome at their job. It takes a while for those productivity gains to show up, even if you're getting highly educated new immigrants. We should realize those gains, though, at some point, especially with this sort of targeted system. Our productivity should kind of get back from being very negative the way it is now to positive. So eventually, our per capita GDP growth, I think, will pick up. I think looking at, I'm not sure it's looking at per capita GDP in a short-term window and declaring something a recession is particularly useful.
I've got a prediction for 2024. Okay. And this is where I think, Brendon, for you're like, finally, our time has come. We're being recognized. I think there's some 4-year-olds, 5-year-olds, 6-year-olds right now in grade 1 or whatever that adds up to be. And they're like, what do you want to be when you grow up? And no more firefighter, no more policeman. They're like, I want to be an economist. And when you go to these forums, is there paparazzi outside when you guys come out now? You're celebrities now. Like, what happened here?
Even my kids don't want to be economists, so I don't think this is going to be trickling down. No, I think I was recognized on the street once. So, and then you just get lots of, like, questions that you have to answer. I don't even tell anyone I'm an economist. I certainly don't tell people I work in the housing market. If you do that at any, like, party, all you're going to do for the rest of your night is answer questions. Like, who wants to do that? And I don't have a slide deck with me, so now I'm like, what am I making? I got to make a presentation at this dinner. Like, what are we doing?
Do you have a fake career? Do you have a fake backup that you'll say?
No, but I should find something super boring. I think I'll tell them I'm in HVAC.
Yeah, conversation ends. Yeah.
No, because then they want you to come over. They want
about that.
Yeah. They're like, oh, mine's making a weird sound.
Fix a furnace, or I shouldn't do that.
Yeah. Hey, in my old career, I used to fix food equipment, and let me tell you what nobody wants to ever talk about. So tell everybody you fix food equipment, and they will.
Yeah.
That's where the shutdown of the conversation happens.
Or like some really boring like manufacturing thing, like some kind of widget manufacturing, and they're like something that no one's like, just we make gaskets. Like, oh, that's awesome. And then they will not talk to you the rest of the night.
Ball bearings.
I'm in the ball bearing business. Yeah.
Brendon, I appreciate you hanging out with us for another hour. I really, really enjoy you coming on the show so much. You're fun. You know what you're talking about. You're not obviously a very, very smart person, but you make talking about what you know and
Not
what you do for
everyone.
Yeah, well, but for what you do for a living, you make people like me and Steve and lots of other Canadians be able to understand it simply, and we appreciate that. And you don't come on here and confuse us with. We also told you before, no big words, right? We made that pretty clear.
Yeah.
But I appreciate you being on the show. Awesome episode. I think our audience is absolutely going to love it. Steve, you got any final thoughts for Brendon?
No, this was great. I appreciate this. Hopefully we can make this some sort of a December tradition for our outlook in the new year.
Always happy to come on. So it was a good time. Thanks. Appreciate it.
Awesome. Well, thank you everybody for watching. Thank you for listening. Thank you to Realty Ninja for sponsoring this episode, and we will see you next week. Bye.
Thanks,
one
Brendon.
sec.
That was fun.